Hold on to your hard hats, folks. It looks like the American oil and gas industry is taking a bit of a breather. Yes, you heard that right. For the third week in a row, U.S. drillers have hit the brakes on their rig operations, signaling a shift in the energy landscape that's as surprising as a Texas summer thunderstorm. But what's really going on beneath the surface? Let's dig in. The Great Rig Decline of 2024. What's happening? As of September 2024, U.S. energy firms have been scaling back the number of oil and natural gas rigs in operation, marking a notable trend that started late in June. The latest report from Baker Hughes shows a drop of 2 rigs, bringing the total down to 583, the lowest since early summer. It's like watching the star of the show take a bow and exit stage left. Unexpected and a little puzzling. This decline isn't just a blip on the radar. It's the first time we've seen such a consistent drop since late June, signaling a broader trend that might be rooted in deeper economic or environmental shifts. Could this be a reaction to fluctuating market prices, or are companies strategically holding back for bigger gains later? Oil rigs on a roller coaster ride, while the gas rigs seem to be on a steady decline. Oil rigs are giving us a bit of a ride. Over August, oil rigs remained relatively stable, even ticking up by 1 at one point. But this week, they stay flat, leaving the total count at 483. It's like they can't decide whether to join the gas rigs in their retreat or keep pumping away. This stability, however, is a bit of a facade. Behind the scenes, companies are grappling with the rising costs of extraction and labor and the uncertainty of future demand as alternative energy sources continue to gain traction. It's a delicate balancing act, and for now, the oil rigs seem to be playing it safe, keeping their cards close to the chest. Natural gas, the big drop. Gas rigs, on the other hand, have been dropping like a hot potato, hitting their lowest numbers since April 2021. This week alone saw a decrease of 2 rigs, with the total count now at 95. The main culprit? Falling natural gas prices, which have been sliding faster than a greased pig at a county fair. The market for natural gas has been particularly volatile, with prices being driven down by a combination of mild weather, high storage levels, and increased production elsewhere. This isn't just a minor setback. This kind of sustained price drop can lead to significant cutbacks in production, as companies prioritize more profitable ventures over gas drilling. The question now is whether this trend will reverse as we head into the winter months, or if we're seeing the beginning of a long-term decline in natural gas production. Why the sudden slowdown? So why the rig reduction? A few things are at play here. First, despite a modest recovery in oil prices, up about 22% so far in 2024, natural gas prices have continued their downward spiral, down by a staggering 28% this year alone. With such low prices, energy firms are cutting back on capital spending, focusing more on paying down debt and rewarding shareholders rather than ramping up production. This strategy makes sense in a market where returns are uncertain, but it also raises questions about the long-term viability of the industry's current approach. Are we witnessing a fundamental shift in how energy companies operate, with a new emphasis on financial health over expansion? Or is this just a temporary adjustment to market conditions? Only time will tell. The impact of inflation. Another key factor is the high cost of doing business. Inflation has driven up the prices of labor and equipment, making it more expensive to keep those rigs running. It's like trying to keep a vintage car on the road when parts keep getting more expensive. Eventually, you just have to park it in the garage. These rising costs aren't just a short-term headache, they're part of a broader trend that's affecting industries across the board. For the oil and gas sector, which already operates on thin margins, the added pressure of inflation could force more companies to scale back their operations, especially if prices don't improve soon. This could lead to a new wave of consolidation in the industry, as smaller players are unable to keep up with the escalating costs. The regional breakdown. Who's pulling back the most? Different regions are feeling the pinch in various ways. The Marcellus Shale, which spans Pennsylvania, Ohio, and West Virginia, has seen its rig count drop to 23, the lowest since August 2016. Meanwhile, the Haynesville Shale, which stretches across Louisiana, Texas, and Arkansas, lost 2 rigs this week, leaving just 34 active, its lowest since 2020. These areas are like the front lines in the rig reduction battle, each taking its hits. The regional disparities highlight the varying economic pressures across the country, with some areas more resilient to price fluctuations than others. This could lead to a shift in where and how energy companies invest in the future, with more focus on regions that offer lower costs and higher returns. The bigger picture: 2023's downward spiral. This slowdown isn't just a 2024 thing. The rig count had already dropped about 20% in 2023, reversing the sharp increases seen in 2021 and 2022. It's a bit like watching a supercar that roared out of the starting gate only to run out of gas halfway down the track. This decline is part of a broader trend that reflects the industry's changing priorities as companies shift from growth at all costs to a more measured, financially disciplined approach. The rapid expansion of the past few years may have been unsustainable, and now the industry is recalibrating, focusing on maintaining profitability in a more challenging market environment. The question now is whether this more cautious approach will pay off in the long run, or if it will lead to a loss of market share as global competitors continue to expand. What does the future hold? Despite the current slowdown, the Energy Information Administration expects U.S. crude oil production to climb from 12.9 million barrels per day in 2023 to 13.2 million BPD in 2024. So while the rigs may be taking a break, the overall output isn't set to plummet, at least not yet. It's like the tortoise and the hare. Slow and steady might just win this race. This projection suggests that while companies are cutting back on new drilling, they're still committed to maximizing output from existing operations. This could mean more efficiency gains and technological innovations as companies look for ways to maintain or even increase production without significantly expanding their rig counts. The big question is whether this approach will be enough to keep up with global demand, or if the U.S. will start to lose its position as a leading oil producer. The strategic shift: debt over drilling. Many companies are now more focused on financial stability than expanding production. With year-over-year spending increases plummeting from 40% in 2022 to just 2% in 2024, it's clear that the industry is playing the long game, prioritizing debt reduction and shareholder returns over aggressive drilling. It's a strategy that's more Warren Buffett than wildcatting, and it's reshaping the energy landscape. This shift could lead to a more stable and resilient industry, but it also carries risks. By focusing so much on financial health, companies may be missing opportunities for growth, particularly in a market that's still heavily dependent on fossil fuels. The challenge for the industry will be finding the right balance between financial discipline and the need to invest in new technologies and resources to remain competitive in the global market. And that's the scoop on the surprising slowdown in U.S. oil and gas drilling. If you found this video informative, make sure to hit that like button and subscribe to our channel. Don't forget to ring the notification bell so you never miss out on our latest content. We've got plenty more insights, analysis, and deep dives coming your way, so stick around and be part of our growing community. Thanks for watching, and see you in the next video.